corporate earnings showed an uptick in the first quarter. At least there were more hits than misses this time around. And the share market has rewarded some of these companies with valuations rising substantially for those pockets as well as for the spaces at large. But should one start celebrating so quickly or practice caution? Joining us now to talk about earnings, valuations and the whole picture is Suhas Harinarayanan, the head of institutional equity research at JM Financial Institutional Securities. Suhas, so good having you. Thanks so much for joining in.
Thank you.
Normally we talk about our earnings roundup. This time around we're doing it slightly late, so might as well combine earnings, valuations and the whole gamut of things. Sure. Now, what do you think of, where do you start off with, valuations or earnings? What do you want to start off with?
I think let's start with the past and then get to the future.
Sure.
I think, so on earnings, obviously, normally when I, come to meet you, I carry a bunch of paper with me, just to see how these different sectors have done. This year I have this quarter I have not felt the need to do it because almost all quarters have seen a good beat or two earnings. There have been a few pockets which have been misses, partly commodity reasons, whether it's airlines, autos, cement, and I won't say, and some bit of raw material. For example, housing finance companies have, cost of funds as a raw material, right? So outside of these pockets, most sectors have seen a, good enough beat. Large sectors, small sectors, and okay, the other pocket which has seen some bit of disappointment has been the building materials. That's been an ongoing phenomena because I think the expected gains from GST is probably not flowing through for a lot of the building materials companies. Now, the right way to put that into context is clearly how have been the 2-year CAGR, because we still probably, hopefully, first quarter FY19 is the last quarter without, or last quarter with had disruptions into it, right? From second quarter FY19, we'll probably have, the normal quarters. I think, analysts like to, or most of us would like to believe that the festive season is slightly earlier this year, so that's a little bit of a mini disruption. But otherwise, we don't have too much of a, disruption starting second quarter FY19. So from that perspective, that's the first thing. Second point is if you look at the 2-year CAGR for a lot of companies in terms of sales volume growth, right? That's pretty, nominal actually. I won't say nominal, but probably very few companies hit double digits, right? So which also goes to show that we've gone through a pretty disruptive phase post DeMon and GST. From now on, we'll see how the earnings pan out for a lot of these high growth sectors. The third part is in terms of earnings growth. While most of us still have a double digit, actually a 20% kind of expected CAGR in EPS over the next 2 years, at least for FY19, I think possibly upwards of 60% of the earnings growth is coming from the large corporate banks, right? So if you include maybe a few other companies which are trading, below 15 PE, maybe 60 to 70% of the, earnings growth is coming from companies which are trading below 15 PE. While those who have the high growth are trading at significantly higher, multiples. So this year, the whole, when you asked about earnings and valuation, the real question is, will these converge? Will we see a convergence of the high growth, high multiples, and the low growth, now low multiples, but now expected high growth companies. That's a test for this year. Let's see how the quarters pan out.
Okay, so before I come to the overall valuation picture, do you reckon that the markets would now, over the course of the next 6 months, try and, other things remaining constant, try and reward these corporations which hitherto have failed in delivering earnings growth, but are baking in a healthy earnings growth and the valuations are better? Or do you believe we follow the template of the last 6 odd months, wherein companies that have delivered might be bought into, never mind the valuations that they are trading at?
So I think two things will happen. One is if we continue to see positive earnings revisions. I think earnings revision is a very important metric to follow. If you look at the NBFC sector, the housing finance companies, the expectation earlier this year was, cost of funds will begin to hit them, and while it has hit their HFCs, The NBFCs as a pack have actually seen an earnings upgrade, right? Which is probably why the non-HFC NBFCs have continued to do well, right? So if you see positive earnings revisions, even in the high growth, high multiple companies, I think those will continue to trade up, right? On the other companies, which are the expected high growth, current low multiple companies, investors have to gain a little bit more confidence on the numbers. Every quarter you had something or the other to worry about. The expectation was maybe from second half, things will be normal. So investors, those probably will see a more gradual appreciation, but I think both can, so in fact, if one is looking at a portfolio, stocks where we continue to see earnings revision upwards, even if they're slightly higher multiple, and those companies which are low multiple and expected high growth, I think both should converge. Yeah, in a little bit more this year compared to the earlier years.
Well, I'm sure a lot of investors in those companies are hoping for that, because it's just that left out syndrome that is probably leading to some of the multiples of the others really skyrocketing. But Suhas, can all of this happen with the valuations the way they are? And we discussed a few charts that we should bring up for the benefit of this discussion as well. Let's pull up a couple of them, predominantly on the earnings, on the valuations front. Firstly, the premium that India enjoys with regards to the compared to the EM markets, and this is how the ratio of the Nifty P versus the MSCI EMP, and clearly shows that we've been at premium, but Suhas also shows that we've been at a premium for a while. What would you attribute this to? The domestic flows, or that India really stands out because of relatively better macros?
If we had met in April, May, which we did, but I think if we had spoken about a little bit more in April, May, there was another elephant in the room, which was rising oil prices, right? I think oil has been a little cooler at this point in time. So we should not ignore, the possibility of, oil going up in the next, 3 to 4 months. So the recent, I think, premium increases also because I think, India's, as some investor like to highlight, India is almost like, like the FMCG for the emerging markets, when oil is not rising, right? So if you see oil rising, I think the premium, because India clearly is far more sensitive to oil prices than some of the other emerging markets. Second is I think clearly domestic flows have helped. There's no doubt on that. I think if you look at monthly SIP flows, that still continues at about $1 billion plus, so that's clearly helped as well. Right, but I would just like to add a word of caution that don't ignore the other elephant in the room, which is oil prices. It can different. I mean, none of us are probably capable of predicting the right price for oil, but that can, if that moves up, I think some of these premiums could possibly come off.
Interesting. There's also a chart that you had told us about, the difference between the GSEC yield and the earnings yield, highest since December 07. Now we pulled that chart up as well, and it clearly shows that difference. By and large, it's at the highest level since December 07. What does this indicate, and does this worry you?
Yeah, so I think the way to look at this chart is it's been a great way to possibly indicate close to tops or close to bottom, right?
For the Nifty as well.
Yeah, I think in a very broad sense, I think a lot of people are also skeptical because the PE for the market is made up of a lot of companies, all the corporate banks, and where the earnings itself tend to be extremely volatile. But in the past, it has been a reasonably good tool to gauge, close to bottom and close to top of the markets. So if you look at these two, clearly it does look as if the markets are fully valued, right, at this point in time. So we'll have to really, look at some of the other individual stock or sector, where you're seeing earnings revisions, or where some of the expected high growth numbers are coming through. The broader market itself clearly looks, a lot more fully valued, than any time in April, May.
Interesting. Having said that, and I think my only counter, or not really a counter, but a question that I would have is that in case of companies which are not levered or which are rather levered, I can understand this chart working beautifully. Have you been able to establish anecdotal evidence of this difference being so high, leading to a top or a bottom relatively for the Nifty?
So my point is, let's not look at it in isolation. I think it needs to, be compared with rate cycle. It needs to be compared with earnings growth. So I think so once you consider those and as I said, expected inflation trajectory and expected growth trajectory for the market, then you're able to get to a more objective assessment of this tool.
So if crude doesn't go up, and if inflation doesn't shoot up, and we do have an earnings growth as well, then you reckon that this difference could stay elevated as well?
For some time, yeah.
For some time,
yes.
Yeah. Okay, interesting. Part two of my question before we come to the immediate here is that, do you reckon that FY20, which will largely be a normalized year, and not just for our markets, I think calendar year 19 for the US markets too, right, could be a lot more normalized because the benefits of this tax cut that came in for the US companies will also go away. Do you reckon that earnings growth has the potency, just in reported numbers, to slow down in FY20, or are conversations with corporates suggesting that base earnings growth in FY20, even on that higher number for FY19, will look at a healthy 15-20%?
To be honest, corporates are not talking about FY20 at this juncture, and I think even for us it'll be too early to, while we put these numbers, it's largely for some sectors we're able to do it, where the runway clearly looks long, whether it's private financials, etc. But for a lot of other sectors, or where there's a capacity expansion coming, it's probably easier. For some of the other companies, it just becomes difficult because we do have possibly another event in May 19 or earlier, whenever the date is right, that could also influence, how the earnings growth pan out.
Yeah.
So it's to that extent, I would not fully agree with your view that FY20 is probably going to be another normal year.
No, I'm asking you. I don't have a view.
No, that's what I'm saying. So if you have another disruption, that's clearly, so while, a lot of us debate about the impact of politics on, macroeconomy and on the markets, I think in the long run, probably doesn't matter. There's a sequence of economic continuity over the past many years, right, starting from 91. This is probably the first year you saw some form of economic discontinuity where you actually had hike in customs duties, not just India, but global tariff increases. But since 91, there's been economic continuity, right? But for the markets, I think these, from a very short term, the political events do matter, and. And I think it's far too difficult for us to take an assessment of the politics at 6 or 7 months ahead of the actual event.
Interesting. Okay, so let's talk about what happens henceforth. Now, what is established is the kind of growth numbers that will come in select private banks, select NBFCs. They might continue the commentary saying that as well. Yeah. The big joker in the pack would be what happens to rural. And there are multiple reasons for that. Elections may be one thing, the MSP hikes coming in. The commentary has been all over the place, to be honest, from a bunch of mid-sized rural-focused companies. What are you observing? What is your belief about what the next 9 months throws up in terms of earnings growth for the rural-focused companies?
I think it should be good. Yeah. So the views, the way to look at rural also is, it's not just agriculture. I think you read a lot about agriculture distress, cotton infested by, pink bollworm and, various other things. But the fact is agriculture has never been, lucrative enough for, farm India, so to speak. And I think what has supported, rural India is basically the general improvement in rural liquidity, So do they have cash to spend, right? So first is, if you look at the farm loan waivers, the farm loan waivers adds up to almost 2.5 times what was given in FY08. That time was central India, this time it's multiple states. The second one is, you had, government schemes, like an MP had a scheme where they ensured that you got your MSP, whatever you sold at in the market at. Third is, I think, there's been an improved financial inclusion, improvement in electricity, which all we discussed last time as well. So clearly the rural liquidity is better, right? And speaking to government agencies at this point in time, they're also taking measures to ensure that they procure a lot of these at MSP, the farm goods. See, if you look at broader agri, so rice, wheat, there's always a decent procurement at MSP. Probably it's pulses and other coarse cereals. And what we understand is even for those, the government is taking adequate measures to ensure a minimum amount of procurement this year. So I would reckon that general rural liquidity should be good over the next course of 6 to 9 months, and I'm not too worried on earnings from the rural companies at this point in time.
So what does that do? I mean, okay, let's try and break this down. What does this do? Let's say, for example, to FMCG names. We've been talking about how the volume growth numbers have looked exceptional for FMCG companies compared to recent past. And there's a portfolio manager after portfolio manager who's come on the platform and said that what stops an HUL, for example, from cranking up these volume growth numbers even further from where they are right now. Where are you on this debate on the volume growth, and thereby leading up to the valuations and the stratospheric valuations that companies like HUL and some of the others are trading at?
So I think I'll break it into two or three ways. One is the 2-year CAGR, as we discussed. I think 2-year CAGR is still moderate compared to the growth in the last 3 quarters. The growth probably started picking up from Q4 FY18, then Q3 FY18, Q4, and then 1Q, right? So I don't think one should extrapolate a 21% volume growth that one of the companies saw to the rest of the year, right? But I think we should see reasonable double-digit growth for a lot of these FMCG companies in our view. I think now whether that exceeds our expectation or not, we'll see at this point in time. Having said that, I would again look at the FMCG companies. While that is a base case that we should see double-digit growth, I look to see where there are positive earnings revisions, and probably only back those names. So we should look at, because I think, as you rightly pointed out, people have already built in that kind of double-digit growth. Companies have been commenting that rural has been recovering strongly. So we should look for positive earnings revisions. So let's look at stocks where there are positive revisions, and I think probably those will still continue to trade at those kind of valuations.
What's top of the mind? Positive earnings revision, FMCG space, and not a call on the stock, just the earnings revision.
Yeah, so I'm not getting into companies per se at this.
Okay, I was just wondering if you guys are factoring in some positive volume growth for some of specific names, not as a stock call really.
So there are
multiple FMCG names. Okay. What about the kind of growth that the rural focused finance companies can show? Now again, let's say I have an example of a Mahindra Finance loan growth numbers that I have pulled out, but it's chalk and cheese because what a recent example. So Mahindra Finance, the numbers have been superb, but it has had a past where it lent itself to some issues. If we just look at what an Equitas or an Ujjivan, or for that matter a company like Muthoot would show because of the Kerala issue, is that once you get into this problem of trying to get in recoveries, this whole focus on growth takes a bit of a backseat, and therefore you lose precious 4, 6, 8 quarters. How do you look at the rural financing companies now?
Again, not picking at names. I think general views that the larger rural financiers should see good growth and should also see good recoveries in the next 6 months.
Okay. So you would be sanguine there. You were not too worried about any kind of delinquency issues or otherwise
not
elections coming in, not
that's a very good point. I think, because, if you look back in FY09 and FY14, I think, there has been a pickup in delinquency in a quarter prior to the election. So let's see. I think, I think the point that I'm also trying to make is the rural liquidity is expected to be fairly strong this time around, So we are not building that as a base case at this point in time. If that comes in, it will be a negative surprise for us.
Interesting. My last piece, Suhas, and again focusing on rural, because the other spaces are more or less well established. The one disappointment for investors this year might have been the performance of autos by and large. I mean, save for 1 or 2 names, Mahindra and Mahindra notwithstanding or Escorts notwithstanding, which is tractors predominantly, PV companies not really out there. Maruti's been a lackluster performer of sorts. Two-wheelers have actually taken it on the chin, arguably because of this margin spat between Hero and Bajaj. What does all of this indicate? Because they would also be large recipients of rural money flowing into their purchases. How are you playing them now?
I think it again probably goes back to the point about are we seeing positive earnings revisions?
Okay.
We are not seeing positive earnings revisions there. In fact, possibly for the two-wheelers outside of the premium bikes segment, which we are quite sanguine about. I think in the other segment, we're probably seeing downward revisions to earnings. Which is clearly why the two-wheeler space outside of the premium bike segment hasn't done well. So is the case with the PVs. There's been no positive earnings revision that we are seeing. Even if you look at this quarter, first quarter, autos is one of those segments which have missed earnings. So in addition to the earnings revision not coming through is a function of the fact that one, earnings expectations are already high. Secondly, you also have the hit from commodity prices, right? So I think so. Yeah, there's a little bit of worry about when the stocks start seeing the putting an end to the earnings downward revision, and So as I said, I think the segment that we really bullish out there is a premium bike segment. But yeah, beyond that, still some bit of caution. Yeah.
Okay, so 30 seconds. We're just out of time completely, Suhas. But is Suhas a more worried man about valuations and market levels than what he was 3 months ago?
Yeah, definitely.
Okay, that's less than 3 seconds, but okay, that gives the answer. Suhas,